Develop a passion for learning. If you do, then you'll never cease to grow. With this note, we shall now head towards the technical sessions set for the day. We hope you all will have a great learning experience throughout the conference. Here we begin with the first technical session on income tax. And to chair the session, we have amongst us a young and vibrant member of the Institute, CA Nishit Bandari. I request Mr. Shreyas, the Vice Chairman of Mangaluru branch of SICASA, the Chairman of Mangaluru branch of SICASA, Gautam sir, to escort the session Chairman, CA Nishit Bandari, onto the dais. CA Nishit Bandari has graduated with a BCom degree in 2016 from St. Aloysius Evening College. He has been a member of Institute of ICAI since November 2019. He has completed his articleship at Shetty & Co. Chartered Accountants, Balmata, and is presently practicing at the same office. A warm welcome to you, sir. I would also like to take this opportunity to introduce the two speakers of this session, that being Mr. Venkatesh Puranik and Mr. Anmol Jain. We would like to formally welcome our chairman for the session. In an era where the investments in bonds, mutual funds, and debentures is increasing rapidly among the general public, it's important to know that the tax on earnings through these investments is treated in a different manner than the cash market. And to help us understand these concepts better, we have with us our first speaker for the day, Mr. Venkatesh Puranik. Mr. Venkatesh Puranik is a CA final student who is currently an articled assistant at Kamathan Rao, Mangaluru. He was the Udupi district topper in SSLC and state second topper in second PUC. He has passed his CA Inter in May 2019 and CPT in June 2018 in his first attempt. A cordial welcome to you, Mr. Venkatesh.
Thank you.
The second topic for the session, the Income Tax Department has launched the new Income Tax Portal on 7th June 2021. This was done to enhance the tax filing experiences of the taxpayers, and the new e-filing portal has been built on speed, accuracy, usage, and convenience. However, we are still not completely introduced to the major changes in the new Income Tax Portal. We have our second speaker of the day, Mr. Anmol Jain, to give us an overlook on this topic. Anmol Jain is a CA final student who has completed his articleship with Grant Thornton India LLP, Pune, in Indirect Tax Department. He has got an opportunity to explore Foreign Trade Policy 2015-2020 and has filed numerous applications for merchandise exports from India scheme and service exports from India scheme. He has recently presented in a webinar called Paricharya, hosted by Nagpur branch of Vikasa on annual return under GST. He has received Best Presenter Award for presenting papers on direct taxation, critical issues in real estate sector under GST, a CA student conference organized by Hyderabad branch in 2020. I accord a cordial welcome to you, Mr. Anmol Jain.
Thank you so much.
I now request the first speaker of the session, Mr. Venkatesh Puranik, to take over.
Let me share the screen with you. Hello, am I audible?
Yes, you are.
Yeah, thank you. Share market is a deep well, which is enough to cover the country's thirst for money. Good afternoon and a great welcome for you all to the presentation. I'm Venkatesh Puranik, here to present on the topic taxation of transactions of capital market under income tax. What is capital market? Capital market is a place where long-term debt and equity securities are traded. Indian capital market includes stock market and a bond market. Stock market is a place where equity securities are traded, whereas in bond market, debt securities are traded. Indian capital market is dominated by two major stock exchanges, NSE and BSE. The picture you are seeing on the screen is of BSE, which is in Dallas Street, Mumbai. Recently, Indian capital market has attracted many new investors. To quote a data, 14.2 million new Demat accounts. 14.2 million new Demat accounts has been created during the financial year 2021 when compared to 5 million Demat accounts in financial year 1920. What are the factors which might have led to this increase in capital Demat accounts? One, COVID lockdown, which has encouraged the people to learn and earn from the stock market. And another reason might be the low bank interest rates, which might have influenced the people to look into the capital market for better returns. And I have to say that one web series related to capital market, stock market went viral. And the Indian stock market is currently in a big bull run where prices are going up day by day. And Nifty has reached 17,000 points a couple of days back. So these all led to the increase in Demat accounts in the stock market. So our clients might come to you. Our clients might trade or invest in securities. They might come to you with queries regarding taxation. So it's a high time to learn the capital market transactions and the taxation aspect about it. So without further ado, let's start the presentation. From income tax perspective, capital market transactions can be divided into three types: derivatives, equities, and debt securities. What is derivative? Derivative is an instrument which derives its value from an underlying asset. Futures and options are the commonly traded derivatives in the Indian capital market. The income derived from derivative transaction is taxed under the head PGBP. Even though derivative transactions appear to be speculative, many people do trade in derivatives, but it is not a speculative transaction as per Income Tax Act. How it is? For that, we have to look into the definition of speculative transaction. Speculative transaction is defined in Clause 5 of Section 43 of the Income Tax Act. Clause 5 of Section 43 of the Income Tax Act says, speculative transaction means a transaction in which contract for the purchase or sale of any commodity. Contract for the purchase or sale of any commodity, including stocks and shares, is periodically or ultimately settled otherwise than by the actual delivery or transfer of the commodity or scrips, provided that for the purpose of this clause, an eligible transaction in respect of trading in derivatives referred to in Clause AC of Section 2 of the Securities Contract Act carried out in a recognized stock exchange shall not be deemed to be a speculative transaction. If you carry out a trading in derivatives in a recognized stock exchange, then it's not deemed to be a speculative transaction. Trading in derivatives is specifically excluded from the definition of speculative transaction by the proviso D to the Clause 5 of Section 43 of the Income Tax Act. So the income earned from derivative transaction would be taxed as a normal business income. The next important point is how to calculate the turnover in case of derivatives. Derivative is a complex financial product, so that for that we can't take just the sale value of the contract, like sale value as per the contract note as turnover. It can't be taken like that. So for that, we need to look into the guidance note on tax audit issued by ICAI. Clause 5.14 B of the guidance note says that total of favorable and unfavorable differences and premium received on sale of options to be taken as turnover in case of derivative transactions. What is this favorable and unfavorable difference? Favorable difference means profit. Unfavorable difference means loss. And in case of option trade, along with favorable or unfavorable difference, you have to add the premium received on sale of options. And the turnover has to be calculated trade-wise and not script-wise. For each trade, you have to calculate the favorable or unfavorable difference. And if it's an option trade, then you have to add the premium received on sale of options. Let's take an example to understand it better. A trader buys a future, a derivative, future is a derivative, at 10,000 rupees, and he sells the same at 9,000 rupees. He made a loss of 1,000. And again, he buys options at 1,000 rupees and sells the same at 3,000 rupees. What is his turnover? The turnover would be calculated like this. He has made a loss in futures, that is unfavorable difference, 1,000 rupees. He had made profit of 3,000 rupees, 2,000 rupees in option trade. That's also forms part of the turnover. Then premium received on sale of options. Technically, when you sell an option, whatever you receive, it's a premium. So 3,000 rupees is the premium received on sale of option. That also has to be included. So the total turnover would be 6,000 rupees. In this manner, in case of derivative transaction, turnover has to be calculated for the section of 44AB and 44AD. Let me ask you a question. In case of 44AD, should I declare the income? What's the minimum rate of income I should declare? Should it be 8% or anything less than 8% can I declare? Yes, I can declare 6% also, because all the receipts will be normally made through banking channels. And in case of 44AB also, tax audit applicability, the turnover cannot be like, the turnover limit is not 1 crore. It can be 5 crore for assessment year 21-22, and for assessment year 22-23, it is 10 crore, because the purchase and sale value, most of the times would be settled through banking channels only, and that satisfy the condition prescribed in 44AB. Let's look into set off of losses and carry forward. As derivatives transaction is not a speculative transaction, the income earned is a normal business income. So the loss from derivatives also can be set off with any income except salary, like a business income. And it can be carried forward for next 8 assessment years. That brings an end to the concept of derivatives. Let's look into equities. What is equities? Equities means instruments having ownership rights or voting rights. The transactions and the taxation aspects can be easily understood with this chart. Equities are further divided into equity shares and units of equity oriented and business trust. In case of equity shares, if you are into day trading, the income would be considered as a speculative business. If it's delivery-based trades in equity shares, then income can be treated either as business or an investment. We will be looking into each of the topics in detail in the coming slides. So let me go to the next slide. Equity shares, day trading. What is day trading? Buying and selling shares on the same day. You buy a share in the morning and you sell this same share before the market closes. It's also known as intraday transaction. In those transactions, there won't be any delivery of the shares. What exactly is this delivery? Delivery means the shares has been delivered to your demat account. Only delivery means the shares has been delivered to your demat account. That only, in that case only, it's considered as delivery. In case of intraday shares, the shares won't come to your demat account only. You buy and sell on the same day, it won't come to your demat account. So it's not a delivery transaction. So that transaction is covered in 43(5), clause 5 of 43 of Income Tax Act, speculative transaction definition. So it is a speculative transaction, and income earned from speculative transaction is it's a speculative transaction, and the business is speculation business. How to calculate the turnover in case of day trading? To calculate the turnover, the rules are provided in guidance note on tax audit. It says that aggregate of both positive and negative differences forms part of the turnover. Positive difference means profit, negative difference means loss. Suppose in one trade, you made 5,000 profit, and in another trade, you made 2,000 loss. Then the turnover would be 7,000 rupees, 5,000 plus 2,000. The negative sign, the loss, you have to ignore. You have to take the absolute value to calculate the turnover. Set off of losses and carry forward. As the income is income from speculative business, the loss can be set off only with any other speculative income. And the loss can be carried forward for only next 4 assessment years. Let's move on to the next topic, equity shares, delivery-based trades. Shares can be held for 2 purposes. One is for investment and another is for trading. If the assessee holds shares as stock in trade, then trading is his business. So the income earned from trading in shares is taxable under the head PGBP, profits and gains from business and profession. There is one exception for this rule, that is foreign institutional investors who invest in securities in accordance with SEBI regulations. For like in their hands, the income earned from shares and securities is always taxed under the head capital gain, no matter what they treat it is. How the turnover is calculated in case of equity shares, delivery-based transactions, short-term or long-term, if the assessee treats it as business. The turnover would be the total sale value of securities. Even dividend is also forms part of the turnover. Dividend received on such shares, where the assessee holds those as stock in trade, also forms a part of the turnover. Even dividend is taxable under the head PGBP only in those cases. As it's a normal business, all usual business expense like rent or anything which is wholly and exclusively incurred for earning that income can be claimed as an expense. Even STT paid also allowed as an expense while calculating income from PGBP, but it is not allowed in while calculating capital gain. We'll look into that in the later slides. Set off of losses and carry forward. As it's a normal business, loss from that can be set off with any income except salary income, and the loss can be even carry forward for next 8 assessment years. But there is one catch here, that is only for companies, that is provided in explanation to section 73. Section 73 speaks about loss on speculative business. What's the treatment? What's the treatment for loss on speculative business? Let's look into the explanation to section 73. It says, where any part of the business of a company other than a company whose gross total income consists mainly of income which is chargeable under the heads income from house property, capital gains, and income from other sources, or a company the principal business of which is the business of trading in shares or banking or granting of loans and advances, where the company which is not following A or B, that company whose gross total income consists mainly of income which is chargeable under the heads of income from house property, capital gains, and income from other sources, or a company the principal business of which is the business in trading in shares or banking or granting of loans and advances, where the company which is not falling in A or B points, if that company involves itself in purchase and sale of shares, then for the purpose of section 73, that part of the income is deemed to be a speculative income as per the explanation provided. So for the companies which are covered in the explanation to section 73, any income earned from trading in shares and securities would be a income from speculation business. So the loss set of rules would change here. The loss it's a loss from speculation business. So the loss can be set off only with speculative business only, income from other speculative business, and the loss can be carried forward for only 4 assessment years. This is only applicable to companies which are covered under the explanation to section 73. Now we will move on to the topic equities, where it's treated as investment by the assessor. Equity shares, delivery based equity shares, units of equity oriented fund, units of business trust. If the assessee hold these securities as investment, then it is taxed under the head capital gains. When to pay tax? Suppose I buy a share today for 1,000 rupees, and after 4 years I'm still holding it, it's trading at 5,000 rupees. Should I pay tax on that 4,000? No. Tax has to be paid only on the transfer of the securities. Capital gains are of 2 types. One is short-term capital gain and another one is long-term capital gain. And that is based on the holding period of the assets, by the assets. Let's look into the holding period. This is self-explanatory. In case of securities listed in recognized stock exchange, unit of equity oriented fund, or unit of UTI, Unit Trust of India, zero coupon bonds, if the assessee held the same for less than or equal to 12 months, for not more than 12 months, then that would be considered as short-term capital asset. Otherwise, it would be considered as a long-term capital asset. In case of unlisted shares, if the assessee held those shares for not more than 24 months, then that is termed as short-term capital asset. Otherwise, it is long-term capital asset. In case of unit of debt-oriented fund, unlisted securities other than shares, the holding period is not more than 36 months for to be qualified as a short-term capital asset, and if it's otherwise, then it's a long-term capital asset. Let's see the tax rates on long-term capital gain. Finance Act 2018 reintroduced the tax on long-term capital gain from financial year 1890. Before, the long-term capital gain on transfer of equity shares, unit of equity oriented fund, unit of business trust, where STT was paid, was exempt under clause 38 of section 10 of the Income Tax Act. But in Finance Act 2018, that clause 38 of section 10 was withdrawn and section 112A was inserted to tax the long-term capital gain on the transfer of those shares. So as per section 112A, a concessional tax at 10% is to be levied on the long-term capital gain exceeding rupees 1 lakh on the transfer of equity share in a company or unit of an equity oriented fund, including ULIP issued on or after 1st February 2021, the receipt of which is not exempt under section 10D. This is a recent amendment in the Finance Act 2021. And unit of business trust. In all these cases, if STT has been paid on the transfer, then the assessee can claim the benefit of section 112A, where the long-term capital gains are taxed at 10% exceeding rupees 1 lakh. In case of equity shares, the STT has to be even paid on acquisition also, but there are exceptions which can be referred to in Income Tax Act. This long-term capital gain, like tax at 10% on the long-term capital gain exceeding rupees 1 lakh, it does not mean that the long-term capital gain up to rupees 1 lakh is exempt. The long-term capital gain up to rupees 1 lakh is taxed at 0% rate. We can say like that, because for the calculation of total income or for any other matter, the long-term capital gain would be taken as full, but only when related to taxation. While taxing it, it would be up to 1 lakh, it is taxed at 0%, you can say that. And above 1 lakh, whatever the difference is there, that is taxed at 10%. The STT payment condition is waived for transactions in recognized stock exchange located in an international financial service center, where the consideration for the transaction is to be received or receivable in foreign currency. India has one international financial service center in Gujarat as of now, where NSE and BSE both have a recognized stock exchanges there. In case of resident individuals and HUF, unexhausted basic exemption limit benefit can be taken. If the basic exemption limit is not exhausted, the assessee can exhaust that basic exemption limit first against long-term capital gain, and then the balance would be taxable. No deduction under Chapter 6A or rebate under Section 87A can be claimed on the tax on long-term capital gain. To understand this better, let's take an example. For an individual assessor who is aged less than 60 years, he has only one income, that is 4.5 lakhs long-term capital gain under Section 112A. What is the tax payable by him? He has only one income, that is 4.5 lakh long-term capital gain. Basic exemption limit is 2.5 lakh. We can reduce that 4.5 lakh minus 2.5 lakh, the remaining 2 lakh. In the balance 2 lakh, up to 1 lakh, there is exempt long-term capital gain. Exceeding 1 lakh is only taxable. So up to 1 lakh, it's taxed at 0%, as I've told earlier. So up to 1 lakh, we can reduce that 1 lakh also. So the remaining is 1 lakh. Can I take benefit of rebate under Section 87A? No, it's specifically disallowed. So I have to pay 10% tax on the balance 1 lakh. So the tax would be 10,000 plus 4% cess as applicable. What is the cost of acquisition with regard to capital assets referred to in Section 112? Many people had invested in equity securities, be it shares or units of equity-oriented mutual funds, thinking that the long-term capital gain would be exempt. But suddenly government brought the rule that the long-term capital gain would be taxable. That's why the government has introduced a grandfathering rule to exempt the long-term capital gain accrued till the date of announcement, that is 31st January 2018. So the revised cost of acquisition is cost of acquisition only, has to be calculated in the following manner. Cost of acquisition shall be higher of cost of acquisition of such asset, the actual cost of acquisition. If it's acquired before 1st April 2001, then higher of fair market value on 1st April 2001 or actual cost of acquisition. Then that cost of acquisition has to be compared with lower of fair market value of such asset as on 31st January 2018 and the full value of consideration. By this, we'll get to know the cost of acquisition in case of assets referred to in Section 112A. And this indexation benefit cannot be avoided if the asset is taxed under the Section 112A. Tax on long-term capital gain, Section 112. Any long-term capital gain other than long-term capital gain under Section 112A is taxed at 20%. Whichever in long-term capital gain under Section 112A, it's taxed separately. But any long-term capital gain other than long-term capital gain under Section 112A is taxed at 20%. In case of resident individuals and HUF, the unexhausted basic exemption limit benefit can be taken. In case of listed securities other than units or zero coupon bonds, shall be chargeable to tax at 10% computed without the benefit of indexation or 20% availing the benefit of indexation, whichever is more beneficial to the assessee. In case of listed securities, if SCT has been paid, then it would be taxed under the Section 112A. If SCT has not been paid, means if there is off-market transactions, in that case, it would be taxed under Section 112 at 10% without the benefit of indexation or 20% availing the benefit of indexation, whichever is more beneficial. Indexation is available only for long-term capital assets. And there's no deduction. No deduction under Chapter 6A also can be claimed against the long-term capital gains, which are taxed under Section 112. We had looked into the taxation aspects regarding the long-term capital gains. Let's look into the taxation aspects about short-term capital gain. Short-term capital gain on transfer of equity share in a company or unit of an equity-oriented fund, including ULIP issued on or after 1st February 2021, the receipt of which is not exempt under section 1010D, or unit of business trust. In all these cases, the tax rate is at 15%. Only if STT has been paid on such transfer. If STT has been paid, the short-term capital gain would be taxed at 15%. As it's a short-term capital asset, there is no indexation benefit as such. This STT condition is waived for transaction in recognized stock exchanges located in an international financial service center. In case of resident individuals and HUF, the unexhausted basic exemption limit benefit can be availed only in case of resident individuals and resident HUF. In no other case, the unexhausted basic exemption limit benefit can be availed in all the while calculating the tax on short-term capital gain. No deduction under Chapter 6A or rebate under Section 87A is allowed against the tax on short-term capital gain. Short-term capital gain on transfer of assets other than referred to in 111A. What are the assets which are referred to in 111A? Equity shares of a company, units of equity-oriented fund, and units of business trust on which STT has been paid. Other than those assets, if there is any short-term capital gain, then that would be taxed at the applicable slab rates of the assets. Bonus shares. If I receive bonus shares, should I pay tax on allotment? That's a question. But there's no tax on allotment as such, because it's merely a reallocation of company's funds. If I'm holding, say, 10% of one company before the issue of bonus shares, even after the bonus issue, I'd be holding only 10%. I didn't get any benefit as such, because like monetary benefit as such directly by the issue of bonus shares. So it's just a reallocation of company's funds as such. So there's no tax on allotment, but it is taxed at the time of transfer along with other shares. In case of bonus shares, the cost of acquisition would be nil, zero. Grandfathering rule can be applied, that is FMA as on 31st January 2018 can also be considered if the assets are acquired before 31st January 2018. Cap on surcharge. In case of individuals, HUFs, association of persons, body of BOI, or any other artificial judicial persons, there's a cap on surcharge at 15% in respect of tax computed on dividend income, short-term capital gain under Section 111A, and long-term capital gain under Section 112A. In case of individuals, like the type of offenses which are referred there is surcharge of 25% if the income crosses 2 crore or 37% if the income crosses 5 crore. But the tax computed on dividend income and short-term capital gain under Section 111A and long-term capital gain under Section 112A would be applied, the surcharge would be applied only at 15%. Maximum 15% surcharge can be applied on these income. This is a benefit given to the assessees. Mode of computation. We spoke so much about tax, capital gain tax. How it is computed? First, we have to take full value of consideration, whatever the consideration received by the assessee. Then expenditure incurred in connection with such transfer. In case he incurred some brokerage charges or anything, he has to. We have to reduce that. Then net sale consideration. Then cost of acquisition would be reduced from that. Exemption, if he's claiming any exemption, then that would be reduced. Then if it's short-term capital gain or long-term capital gain based on the holding period, whether it's a short-term capital asset or a long-term capital asset. No deduction of STT paid can be, no deduction of STT paid. STT paid is not, cannot be taken as a deduction while calculating the capital gain. There is the issue on sale of shares. If I trade in shares, should I show the income under capital gain or PGBP? It's an ongoing issue. The capital asset definition as per Income Tax Act, it excludes stock in trade specifically, but shares and other securities can be held either as capital asset or stock in trade or both. So the determination of character of the investment, whether it's character of the holding of that shares, whether it's stock in trade or investment, that has to be fact specific. It differs from case to case, and it has over the years has led to a lot of litigation in the past. So CBDT has issued one circular number 6 2016, and this circular is only applicable for listed shares and securities. In this circular, CBDT has instructed the assessing officers to take into account the following points. If assessee declares that from trading in shares, if he declares that income as PGBP, assessing officer need to accept the same. He should not contest it again. And if the assessee declared it as capital gain only in case of long-term assets, then assessing officer need to accept the same also. And the assessee should continue the same treatment in subsequent assessment years. He should not change his stance in the subsequent assessment year. He should continue the same treatment. In any other cases, the CBDT instruction number 1827 dated 31st/8/1989 has to be followed, or CBDT circular number 4/2007 has to be followed. But in those two circular or instructions, there's no clear-cut guidelines as regard to how to tax, like whether to tax it under capital gain or PGBP. There's no clear-cut guidelines. It says it's based on frequency, volume of the transaction, etc. In case of unlisted shares, CBDT through letter dated 2/5/2016, it says that income earned from unlisted shares should always be considered under the head capital gain. And circular number 4/2007 even says that assessee can have two portfolios. One is for investment and another one is for trading. But it's better to maintain it in two demat accounts. So to identify it very easily, whether it's business income or capital gain income. Let's move on to the next topic, debt securities. All debt securities are taxed under the head capital gain, and long-term capital gain in case of various debt securities. I've summarized this in this table. If it's listed debt securities other than units or it's zero coupon bond, then the tax would be 10% without indexation or 20% with indexation, whichever is beneficial. In case of listed bonds and debentures, it is 10% without indexation. In case of unlisted bonds and debentures, it is 20% without indexation. In case of bonds and debentures, generally indexation benefit is not available. If it's listed or unlisted units of debt-oriented fund or any other unlisted debt securities, it is taxed at 20% with indexation benefit given to the assessee. Benefit of indexation in case of bonds and debentures, it's generally not available, but it's only available for the following. One is capital indexed bonds issued by the government of India, and another one is sovereign gold bonds issued by the RBI. In these two cases, you can take the benefit of indexation also. And no deduction under Chapter 6A is allowed against long-term capital gain under Section 112. In case of short-term capital gains, in case of debt securities, it's taxed at the applicable slab rates of the assets. To conclude my presentation, capital market is not something which was set up in a day or two. It is dynamic and it has been evolving over a period of time. What is constant in this market is change. Change is a constant. So as a professional, we have to equip ourselves with the recent changes in the capital market so as to serve our clients in a proper manner. Thank you for being a wonderful audience. I'm grateful for Mangalore branch for giving me an opportunity to share my thoughts with you all. And I'm grateful for my sirs, especially Chairperson Nishit sir, for helping me out with the presentation. Thank you, one and all.
Thank you, Mr. Venkatesh, for the wonderful presentation. The participants are now free to post their questions either on the chat box on Zoom, or you can post your questions now to the speaker. If you have any doubts on the topic, you can raise your doubts or questions now. The speaker will be available to answer these questions. With this, we come to an end of the first topic of session 1. I now request the second speaker of the session, Mr. Amol Jain, to take over.
Hello, am I audible?
Yes, you
Yeah,
are.
you are audible.
Yes.
Yeah, clear.
Just confirm when my screen is visible.
Yeah, it's visible. It's visible.
Okay. Hello, a very good afternoon to all of you. After a very insightful session on taxation of capital market transaction by my friend Mr. Venkatesh, I welcome you all to the second part of this session. And now we will be discussing some major changes and new utilities in income tax portal. Just recalling the history of income tax portal, the e-filing project is an eminent e-governance measure taken by the income tax department, definitely for better services to the taxpayers. And laid back, it was notified in 2006 and 7. Further, during the financial year 2012 and 13, the e-filing website has been revamped and made available on 9th of November 2012 with many new utilities like extension of electronic filing of all other forms as prescribed in IT rules. Also, it enabled access to history of returns filed by the taxpayer and other services in the e-filing website. This project is aimed at enabling e-filing of income tax returns, audit reports, and other forms of income tax over internet directly by the taxpayer. A portal earlier, Income Tax India e-filing.gov, was functional with a host of services to taxpayers. And now, after almost a decade, the Income Tax Department have introduced a new income tax portal considering the drawbacks of the old portal. And some of the drawbacks were the pre-filing of ITR forms was not available on the earlier income tax portal. A 10 MB limit while replying to the notice in any proceedings was set, and there was no mechanism to post reminder before the assessing officer. For example, if a proceedings is going on and if you feel that some time limit is lapsed, you were not able to allow to remind online to the assessing officer. Definitely, physically, you can visit the department and discuss your queries. Very basic dashboard with no details of pending return filing. So if you have noticed, there was no details stated on the dashboard of older income tax portal. There was no designated mechanism to initiate stay or rectification application post completion of proceedings. Although with so much of changes in the digital board, in the old income tax portal, there was no mechanism to apply for a stay or rectification application. There was limited informative material available on the old portal. So now, to change all such things, if we remember, a press release in January 2019 was issued, and it was stated that the Unit Cabinet, chaired by the Prime Minister Shri Narendra Modi, has given approval to expenditure sanction of approx 4,200 crores for an integrated e-filing and centralized processing center 2.0 project of the Income Tax Department. This proposal ensured the continuance of the department's goal towards transformation through technology. The e-filing and CPC projects have enabled end-to-end automation of all processes within the department using various innovative methods and to provide taxpayers services and to promote voluntary compliance. Further, methods to provide taxpayers were also provided. So now the Income Tax Department has launched the new income tax portal on 7th of June 2021. The portal link has now changed to www.incometax.gov.in. To enhance the tax filing experience of taxpayers, the new e-filing portal has been built on speed, accuracy, usage, and convenience. The portal has been developed as a mission-owned project under the National E-Governance Plan. Let's now have overview of the changes on the new income tax portal. So there are multiple methods to pay taxes on the new income tax portal. Enhanced help section with user manuals and videos are available. We will be discussing this in detail in the later slides. Role-based and user-friendly dashboard. You will be noticing a very interactive dashboard in the new income tax portal. Secure and multiple options for login. So there are multiple options available while logging into the new income tax portal, which was not available in the old portal. Wizard-based assistance in ITR selection and pre-filed ITRs. The new income tax portal will now make use of some artificial intelligence and help you out with a pre-filled ITR form. This new income tax portal can also be operated in a mobile app and which will support Android as well as iOS. A chat boot is available where you can post your query, and if it is in the server which is pre-filled with pre-filled questions, it will promptly respond you with a quick answer. And the ITR utility is also very easy to use. Further, there was a press release issued by the department which stated that the new user-friendly income tax portal is integrated with immediate processing of income tax returns to issue quick refunds to the taxpayers. This feature aims to solve the hardship of the taxpayers which were caused due to the delay in processing of income tax returns. A single dashboard has been introduced for the taxpayer to take a quick response and a follow-up action for all interactions, communication, and pending actions, etc. Free ITR preparation utility has also been released with interactive features to help taxpayers file ITR 1, 2, and 4 for now. However, similarly, the preparation utility for ITR 3, 5, 6, and 7 will also be released shortly. The portal has introduced an update profile feature. The taxpayers will be able to proactively update their profiles with details of income from salary, PGBP, house property. That will definitely help the portal to use this information and pre-fill your ITR. Further, a call center for taxpayer assistance has been set up under the new income tax portal. Taxpayers can now ask queries and get a prompt response there. We know how the department works. The best we can do is to expect a really prompt response. Now, there are few changes on the income tax portal. Now, before availing any services offered by the income tax portal, you need to register and log in the portal. The portal is providing various options to log in. You can log in using your PAN details. For individuals, you can log in using your Aadhaar card. And for chartered accountants, tax deductor, and tax collector, there are options available to log in through Aadhaar or TAN, etc. Once you log in, the dashboard will provide you with your details such as name, your PAN number, and mobile number with email ID. A good point to notice here is the new income tax portal dashboard will also state the total outstanding demand, which was not provided in the earlier portal. Further, you can also see that the taxpayer can now access the persona-based help content. For example, if I select individual, I can select, am I a salaried employee, a business, or in a profession? And after selecting the other part, it will give you details about the guidance to the tax return, as well as what the tax slabs applicable to you, your refund status, and other related information on a single dashboard. It becomes very interactive, and this feature is also available for companies, non-companies, and other tax professional and others. The new income tax portal also now provides quick access to links to e-verify returns, where you can e-verify your income tax return. All these services mentioned in this slide are available even without logging in. You can also link your Aadhaar card with PAN, which is very important, though the date of linking this is extended by the government. However, this facility is provided on the new income tax portal. You can check the status whether your income tax and PAN is whether your PAN is already linked to your Aadhaar card or not. You can also pay tax, your pending tax on through this portal. However, it was clarified that the tax payment system will be launched on June 18th. However, we still face many technical glitches while making payment. You can also track status of any e-file returns. Further, you can also verify your PAN. You can also get details of your TAN, etc. And I've already mentioned that these services can be availed without logging in into the portal. Further, if you will see, the income tax portal have access to enhanced and user-friendly help section. This was already mentioned in the press release. So now the taxpayers can use the detailed user manuals, FAQs, and videos to avail various services available on the portal. I've personally gone through such videos, and these videos are in detail and will help you down to how to process for a particular thing on the new income tax portal. In addition to this, a chat bot and a help desk has been enabled for the taxpayers for quick guidance. Further, now the dashboard provide variety of details such as the tax deposit made, resale filed returns by the assessee, any pending actions. So this facility of showing any pending action was not there in the old portal. You will also able to view any recent forms which has been filed, the grievances which have been filed. A new feature here is the activity log. Here the portal also provide you details about the last login and the last logout. Further, in the new portal, there are options available for filing income tax form, and these form includes form 10CCB, 10CCBBA, CCBC, and other various important forms. However, we can understand that few of the forms have not been functioning correctly, and we are observing persistent technical glitches while filing such forms. Further, there is also on the dashboard, there is a summary in graphical form of tax deposit of the assessee. So you can observe here is they have provided the summary in a very interactive graphical presentation. You can definitely track this down and use this information for various decision-making purposes. Further, it also provides a roadmap of return filing. So for example, here it is showing that this return is processed on June 5th and it is processed with refund on 8th of June. So these details are very much useful for taxpayers. Now, further, when you log in and will try to file your returns, you need to fill up some schedule questions which are there. So on the basis of the schedule which I've selected, a number of questions will be there and you need to answer the same. Your answers to such detailed question will allow the portal to draft a computation of income and a pre-filled ITR. So for example, here they are asking you, are you eligible to claim exemption in respect of expenditure incurred on cost of travel, etc. They are also asking about exemption in respect of special compensatory allowance, etc. So these are some of the questions which you need to be answered. They have also asking the amount of deduction you need to claim under various sections, for example, under section 80CCD or 80C. The new income tax portal will pre-fill the return based on the details available with the income tax department. The taxpayer now is required to confirm the details and move ahead. If you think there are any changes to it, you can definitely edit the same and go ahead. Further, it is very important to note this is that declaration of at least one or more bank account held during previous year is mandatory. So the said bank accounts are required to be validated. So you need to fill your details of the bank account and validate the bank account. So this will help the authorities to release the refund in the right bank account. Further, you have an option to nominate a particular bank account in which you want your refund claim to be processed. There is also a possibility that the bank account is pre-validated, and we should check in all our clients whether this is done or not. The new income tax portal also requires a quarterly breakup of income from other sources. So you need to provide a quarterly breakup of any of your income from other sources. Further, we are aware that in the earlier portal we need to go through so many of schedules while giving details for capital gains. Now they have provided you with capital gain asset wise options where you can select what type of capital assets transaction you have held in the previous year. For example, whether you have sold any land or building or both, whether any bonds or debentures other than capital index bonds have been sold by you. So for example, from sale of securities by an FI as per the section 11580. So after ticking all the relevant boxes, after this processing the same, you can easily go through the capital gain transactions. Next, I will discuss now some basic features of e-proceedings on new portal. So if we'll compare from the old portal, there are no drastic changes from this point of view. However, the cap on upload size of the file limit in the new portal has been reduced to 5 MB. A zip folder can be uploaded for submitting the response. The size of the zip folder cannot be increased more than 50 MB. Only the interface of e-proceedings have been changed slightly. View of the ongoing proceedings has been also changed. So now, if notice is served and it requires in a return, a message will appear after opting to submit a response in relation to the proceedings. And also, e-verification has been made compulsory for submitting the response. It is not necessary for seeking adjournment and video conferencing request. A new type of feature, that is seek clarification, is added. Seek for clarification communication is sent to the taxpayer if there are instances where the information provided under a schedule or annexes of the return is insufficient or inadequate and clarification required on certain claims by the taxpayers. So the assessing officer can use this seek clarification option and have clarification from the assessees. So category of evidence now in a tick format, and there is no drop down as it was earlier. Moving ahead. So this is a statistics which is mentioned on the income tax website. If you can see, as on 30th April, 10 crores 6,71,000 users were registered on the older website, and on the new website as on 30th May, 9 crore 48 lakhs were registered. So I understand few have dropped down or they have yet to be migrated. And the return filed is approx 6 crores 83 lakhs, and out of which the e-verified returns were 6 crores 1,46,000. So there are various services which is also available on the new income tax portal for a chartered accountant. So a chartered accountant can file statutory forms, and this can be done only once you are added as a CA by a taxpayer and you have accepted the request. A chartered accountant can also e-verify the forms assigned to him by the taxpayer. It can also assist in uploading bulk form, for example, form 15CB. The chartered accountant can also view filed statutory forms which have been filed by the assessees. It can also view and submit the grievances. It can also help in setting higher security logging options through the profile of the SSE and register his DSC as well. So all such things on all the services is only available after a CA is have a valid DSC and it is registered on the new income tax portal. Further, the services on the new income tax portal for tax deductor. So it can also definitely it can file income tax forms, and it can also view forms which have already filed, manage ITDREIN. It can also, the tax deductor can also initiate have services of e-proceedings, and also definitely can view and submit the grievances, if any. Further, the services available for external agencies. So now we all are aware that a number of e-compliance and other external agencies are available in the market. So there are a few services which are also available to them on the new income tax portal. So some services are file income tax form. So the external agencies can help the large SSEs to file income tax forms, view forms which have already been filed, verify bulk PAN or TAN. So the external agencies can help to verify in bulk PAN and TAN. They can also help to verify PAN details. So they can also view status of the token which have been raised and view and submit the grievances. Now I will discuss some other updates. So you must be aware the Central Board of Direct Taxes and Central Board of Indirect Taxes have signed a pact for data sharing. So in addition to the regular exchange of data, now the CBDT and CBIC will also share with each other on request and spontaneous basis any information available in their respective databases, which may have utility for the other agencies. So for example, if the Central Board of Direct Taxes thinks that they require of a particular SSE some details regarding the indirect taxation transaction, they can definitely contact the CBIC and get the details spontaneously. Further, a MOU between the CBDT and SEBI is also signed, and this MOU will definitely help the Central Board of Direct Taxes to seek any information of a particular SSE from Security Exchange Board of India. So such steps definitely makes interlinking between these agencies and departments, and from a revenue point of view, this will definitely help them to drill down in a particular SSE and to check whether the SSE is evading any tax or not. Now we'll discuss some income tax utilities, income tax form utilities. So we all are aware that a taxpayer can file ITR in two ways. There is an option to file online, where the taxpayer has to enter the relevant data directly on the portal and submit it. So taxpayer can file in such form ITR 1 and ITR 4 online. In the offline form, the taxpayer has to download the applicable ITR, fill the form offline, save the generated XML file, and then upload it on the portal. So to e-file the ITR using the uploaded XML method, the user must download either of the following utilities. So there are two utilities available on the portal. One is Excel and one is Java utility. And if you'll just visit the new income tax portal, and in the download option, if you need to select the assessment year, the portal will help you to download the common offline utility. Currently, offline utility for ITR 1 to ITR 4 is available. However, offline utility for ITR 5 to 7 is still not available and will be hosted shortly. So if you'll just see the new utility, when the taxpayer log into the utility and fill the details about the PAN and all, the utility provides us a chance to make changes in the status if it is not applicable to you. So for example, I have logged in as an individual. You can also change the status to HUF, and in the others option, the only available is as a partnership firm. So a new form 10IE is required to be filed if you want to opt under the new scheme. So the form can be filed by the individual and HUF to exercise or withdrawal the the option of the computation of taxes under section 115 BAC. And the e-verification of this form is mandatory, and this can be done through DSC or EVC. So we all have noticed some current issues which are there and technical glitches on the new income tax portal. I've captured some of them here. We have noticed that sometimes the portal is incorrectly linkaging the names. So for example, here if you have noticed, it is Jatin Mishra, son daughter of Rajesh Garg. So this is a big mistake. And secondly, I have captured here is there is an erroneously they have stating that twice a same ITR is filed. So if you can just see the date is same, everything is same, but the ITR is showing as twice filed, and one is under section 139(1) and the second is filed under section 139(4). So these are some of the technical glitches the taxpayers are facing. So we can say that for time being, the old portal versus the new portal, the dream we thought of while going through the press releases and other information which the CBDT is providing before launching the portal has been like this. However, in reality, it has turned to like this because there are numerous technical glitches, and we are expecting these will be resolved soon. But we also need to consider the amount, the number of assessees the CBDT is dealing with, and we hope that these issues will be resolved soon. So if you have noticed that this is a notification when you just log in into the new income tax portal, it states that filing your ITR is easier than ever before. But considering the current technical glitches, this is not something rightly mentioned here. And definitely, this is also, you can also notice all such things in Twitter storms, where various tweets and social media, you can observe in the social media the issues which have been faced by the taxpayers. So definitely, it has been always a pleasure to present paper in the conferences. I would like to thank you and appreciate the efforts made by Mangalore branch of SICASA as well as the Institute of Chartered Accountants of India. Further, I will also like to thank the session chairman, Nishit Bhandari ji, for providing his valuable inputs on my topic. Thank you so much.
Thank you, Mr. Amol Jain, for the meaningful and wonderful session. The participants are free to post the questions on chat box on Zoom. Meanwhile, I will request Mr. Venkatesh to answer the questions that are posed on the chat box on Zoom regarding the first topic of the session. There are 3 questions raised on the chat box.
Let me take it over. Okay. A question asked by Nahid. One who is new to stock market, what would be a good source to learn about investing? I personally recommend Nahid to visit. Let me share my screen once. Okay. My screen is visible, no? Yeah. I personally suggest you to check into the Zerodha Varsity. It's an open source education, like open stock market and financial education portal created by Zerodha, #1 discount brokerage in India. It has many modules as such. Even I had went through many of the modules to gain knowledge regarding the investment and stock market as a whole. I personally recommend you to go through the Zerodha Varsity portal. Then you can refer finshorts.com also. It also has good coverage of the Indian stock market. And for news and for analyzing the stocks or shares, you can refer moneycontrol.com. These are the 3 websites I recommend you to go through. Then, let me stop this. A second question. by Jasmita, how to classify debt and equity. I think in case of equity shares, there won't be any confusion. It's always equity. But in case of mutual funds, we might get confused whether it's a debt mutual fund or an equity mutual fund. As per the provisions of the Income Tax Act, generally the mutual funds, if they invest 60% of the proceeds in in domestic listed companies, then that would be considered as an equity oriented mutual fund. If yes, it's classified as a debt oriented fund other than equity oriented fund. So I would recommend you to go through the scheme documents of that fund or anything as such, whether if that fund is investing in equity securities, then it would be considered as equity. It can be considered as equity. And if that fund is investing in debt securities, you can consider as debt. And one more question by Arjun Rao. How do we declare F&O income tax return? As I have discussed in the presentation, F&O income, futures and option income, is normal business income, and the turnover has to be calculated by taking favorable and unfavorable differences and premium received on sale of options in case of options trade. If the turnover crosses 5 crore for this assessment year 21 or 21-22, or 10 crore in assessment year 22-23, the books has to be audited by a chartered accountant. Here, you can show it as a normal business income, where you can show the sales figure as the amount of contract you have sold, and the purchase as the amount of contract value of purchase, and the net difference would be either profit or loss. You can show it as a normal business income. I think I have solved the queries of the three.
So I have
there are any more?
So it's on me from Ashish. Am I audible?
Yeah, you are audible, Anu.
So the question is, can a CA help his client assessee to opt out of higher vol security option? So I understand, yes, he can, but the conditions remain the same. So CA needs to get registered, and I understand this notification will be there on the assessees, and it need to accept it. However, if you have not personally tried out this, but if you have tried and you are not able to, you can expect, you can wait for some time, or else I will definitely try this out as well, and will get back to you.
Yes, thank you, Mr. Venkatesh, for answering the questions for the participants. We have one question raised on the chat box for Mr. Anmol. It's answered. So thank you, Mr. Anmol, for that. We now request our session chairman, CA Nishit Bhandari, to give the concluding remarks for the session.
Good evening, all. At the first, I would like to congratulate both the speakers who have covered the topics comprehensively. To add on to their topic, first of all, I would like to begin with the capital market transactions. To claim the concessional rate of 10% on under section 112A, on both the purchase and sale, the STT should have been paid. But there are few exceptions provided where the STTs are not paid, like bonus shares, right issues. In such cases, even if on the purchases the STT is not paid, the sale will be eligible to be taxed under section 112A. Next, the mutual funds, and I think Venkatesh has clarified it, what is called as the equity oriented fund and what is debt oriented fund. The equity oriented fund is which 65% of the total investments are invested in equity scrips or equity instruments. Suppose if an mutual fund is investing in another fund, then the 90% proceeds of such mutual fund should be invested in equity oriented funds. Then it will be eligible to be the equity oriented mutual fund and eligible to be claimed under section 112A. Second thing is there is one more concept called as equity linked savings scheme. This equity linked saving scheme has a 3 years lock-in period, and it is eligible for deduction under section 80C. Most of the times, some assessees get confused with the equity oriented fund and equity linked savings scheme and claim 80C benefit in respect of their investment under equity oriented funds, which is not correct. As during your articleship period, you have to clearly verify whether it is an equity linked savings scheme or an equity oriented fund before claiming deduction under section 80C. On completion of 3 years, when the equity linked savings scheme is transferred, the taxation is similar to that of equity oriented fund, that is under section 112A. And recently, in the Finance Act 2021, exemption on unit linked insurance policies has been withdrawn from section 1010D if the total investments or the total premium paid on equity linked equity linked insurance policy exceeds 250,000. Then such equity linked equity oriented policies are liable to be taxed under section 12A. Second thing, when the stocks are classified as stock in trade or your investments. Suppose, what are the benefits you will get if you classify the stock as business? One, you can claim STT as cost of acquisition and cost on transfer, but no such deduction is allowable if you treat the shares as investments. Secondly, in the example of Venkatesh, suppose a trader has got a profit of 450,000. His income will be total income will be 450,000, but he will be liable on 10% rate on the 1 lakh after reducing the basic exemption limit. But there is no rebate under section 87A. But in case of an trader who is treating his stocks as his stock in trade and offering the income under the business, the basic exemption limit of 250,000 will be exhausted, and on the additional amount of 2 lakhs, there will be tax of 5%, that is 10,000. But the rebate will be granted under section 87E. Plus, the dividend income will be taxed under the head business itself, and it will be added to the turnover of the assessee. Now, coming on to the new changes on the IT portal, instead of telling the changes, there are a lot of glitches. So it is not functional yet. I would suggest tell that it is under testing stage yet. So on talking about the proposed changes in the portal, the basic intention is to reduce the interaction of assessees with the AO. So the faceless assessment has been introduced in the now, plus rectification process is going to be online, penalty proceedings is going to be online, revision proceedings 263, 264 proceedings are going to be made online. So there will be reduced interaction with the AOs. And recently, I think most of the students have filed responses to e-proceedings in the old portal. Earlier, there was no requirement of getting the OTP. It is an, or e-verifying the submissions while filing. It was an option available to the assessee. But as per rules, you had to submit the signed copies to the jurisdictional AO if you have not verified the submissions. But now the e-verification has been made mandatory. So now for every submissions, you may have to call your assessees to get an OTP, or you must have their digital signature. So to avoid this, they have given a functionality called as add authorized representative. You can add, assessees can add CAs as their authorized representative. All the proceedings which is visible on assessee's window will be available to the CA through his login. So he can file his response there. Second, and one more common functionality available in the new portal, it is set to be introduced for today's topic, is that all your capital market transactions will be available in the new portal to so that the capital gain on capital market transactions will be readily available on the portal. You need not compute, just you need to reconfirm whether it is correct or not. So with this, I would like to conclude my speech. I'd like to thank Mangalore branch of SIRC to giving me an opportunity to chair the session. Thank you very much.
Thank you, sir. I would like to thank the speakers for their meaningful sessions for the day. Mr. Venkatesh Puranik, as explained by you, the capital market transactions and the taxation and tax treatments on these trade derivatives are completely understandable, and I hope all the participants have benefited from this session. Also, Mr. Amol Jain, you have clearly explained the new options available for the CAs and the taxpayers on the new portal, such as the utilities and many more. I hope all the participants will have the benefit of filing the returns for their clients with much more ease with this session. And also, I would like to thank our chairman for further clarification and enhancing our knowledge more on the topic regarding the capital market transactions as well as the new portal of income tax, and helping us know more about both the topics. Thank you, sir. I request our Chairman of SICASA Mangalore branch, CA Gautam Pai, to present a token of gratitude to our chairman of the session. Thank you, dear participants, for your cooperation. We'll now move on to the next session.